I also messed up. I'm messing up really bad today because I forgot to hit the start recording button also. So we're starting to record from this point forward. So as I said, we have many different types of triangles. And it's finding them when they appear on our charts. And then preparing for when they break out and how to trade them. So let's go back to my PowerPoint. So many breakout traders use triangle formation to identify breakout entry points. Okay. There are different kinds of triangles that can be seen on a price chart. Again, we don't need to sit here because the rules are the same no matter whether it's a ascending, descending, symmetrical triangle, whether it's a pennant, whether it's a flag, whether it's a wedge. The rules of trading are the same. The important thing that we can get from the triangle is the breakout. The breakout, when price breaks, the move, the target price should be equal to the distance of the break or the base of the triangle. Because we have to be able to set a target point to calculate our risk-reward ratio. So if we take the base of that triangle, okay, and lay it on the price when it breaks out, we can measure our target. Because remember, our target's only an estimate anyway, here. Because then we have to ascertain where we'd have to put our stop loss and where we would enter the market so that we can calculate our risk-reward ratio to see even if we can afford to make this trade. So whether we have an ascending, descending triangle, we're still doing the same measurement. Now what happens is when we have an ascending triangle is supposed to have a bullish characteristic. In other words, it's supposed to break out upward. Well, if you measure that base and you're just sitting here waiting for that upward breakout, well, you're not prepared because it could break out downward. Okay. Now, I'll show you towards the end of this that I've actually done a study on a whole bunch of triangles. And the only difference between predicting the characteristic and not is like 48 to 52%, which is not enough for me to judge or confirm my trading. Now, it's important to mention that the ascending and descending triangles sometimes break through the incline level, causing false signals and trapping some traders along the way. The same holds true for the horizontal price zone. You should always try to wait for the close of the candle to confirm the breakout. This will help reduce many false signals. So in other words, when price breaks out, okay, of your triangle, just because it moved out in the middle of a trading session doesn't mean that it is a good breakout. You need to wait for the actual candle to close outside of the triangle. Let's see if I can get this so you can see it better. So here we have a candle or formation happening, and we see price broke out, but then it moved back right back into the triangle. But then it finally broke out and it closed outside the triangle. Once it closes, okay, then we have a good breakout. Now, my rule of thumb is I need to wait for the next candle. That's my confirmation candle. I have my breakout candle, then I have my confirmation candle. Yes, you could lose a few points of trading or miss some trades entirely, but you also miss all the bad trades. So you have your breakout candle and then you have your confirmation candle. Once you get that confirmation, and that's always on a close, you would then enter with the entry point being equal to the close of that breakout candle or better. You would set your stop loss at the most recent swing low before the breakout. So yes, a lot of people and a lot of systems have you the minute it breaks out of the triangle, initiating a trade. And then you set a very tight stop loss. And if it bounces back in, your trade gets closed out. I would much rather, my own system is that you wait for that confirmation candle, set your stop loss at the swing low or the lowest swing low before the breakout, and enter there and take your target point. Because yes, you miss trades, but the trades you get will be much more reliable in the long term. And I always search for every high probability trade that I can find with the highest probability of success. So remember, whether we're trading symmetrical triangles, rising wedges, bearish pennants, increasing wedges, they're all the same. The rules remain the same. Okay, the steps remain the same. So we would set our buy at the close of the breakout candle, but we wouldn't actuate or execute our trade until we have the confirmation on that second candle. We would put our stop loss at the swing low, the lowest swing low before the breakout. So once a triangle is identified on chart, traders will wait for a breakout either above the resistance trend line or below the support. After a breakout is confirmed with either a closed candle above resistance or below support, a stop loss is placed approximately 10 pips below the last swing low of the triangle. A limit equal to the height of the triangle is then placed. So here we go. See here, that candle touched it, but it's not a breakout. Here we touch the bottom, not a breakout. Now we broke out here. Here is a problem. We have a bearish candle, but it did not, the low did not take it back into that triangle at all. But I would use the close of that bearish candle for my entry point, and I enter because it still serves as your confirmation candle because it didn't go back in. We use that for our entry point. Here's our breakout point. Our stop loss is a few pips below the swing low, and our target is the height of this base. Now, of course, depending on your experience, and now there's a couple other confirmation tools you need because now you're setting up your trade, but there's two more things that we have to look at because this sounds really simple. And this is too simple because you would end up having a lot of potential loss. So how do we confirm that we actually want to make this trade? Anybody out there give me any guesses? Well, the first thing, we've calculated our entry point, we've calculated our stop loss, our take profit, we've seen our risk reward ratio. Is volume. Now remember, volume on your CFD platform, on your Avexo platform, only shows you the volume of that asset in relationship to the liquidity providers because there's no exchange around the globe that's tabulating volume. Now, if you're trading stocks or commodities, you can see all the contracts, but we must see a jump in volume. If you don't see a jump in volume, that means there's no conviction in that breakout and don't make the trade. The other thing we need to look for at all times is our levels of support and resistance around the breakout. We're not talking about the lines that form the triangle. We're talking about real or actual support and resistance levels. So here we have a good triangle live chart. Okay, we've got our breakout. We have our confirmation. See, now it did step back in, but we already had our confirmation. We would have already executed a trade. It didn't come anywhere down near our swing low. And eventually our trade would have made us some profit up to here. Okay. But the other thing we have to look at is here we would have set our base here, which I'm just guesstimating would have been here. What we have to look at is where the next support or resistance level is on our chart. Because if our next line of resistance was here, but our target point was there, we have to say, we need to recalculate our target to the next level of the next major level of resistance, because we cannot just say, price is going to soar straight up there. You have something, an impediment in the way. You have something that's going to stop you. So therefore, we have to recalculate our risk-reward ratio. So what are we looking at? We're adding in our support and resistance levels, and we're adding volume into our trading decision. With those together, now we have the probability of a highly successful trading strategy or trading scenario. So we set our buy, our stop loss, and then our target points. Again, stop loss. Let me get my highlighter on here for you. Stop loss. Breakout. Confirmation candle. Entry point. Trade. Opposite, whether it's moving up or down, whether the breakout is up or down, we do the same calculations, just flipping them over. Now, when a pattern ends, as price moves into the center of that apex of the triangle, the volatility dips to a minimum, and the support and resistance lines will get very close. The market will then usually start to show some preferred direction. There's no guarantee of this, however. As always, it's best to prepare for false breakouts and retest of the support and resistance lines. The easiest way to trade this pattern is to treat it like a continuation pattern. While there are instances when triangles mark important trend reversals, they often mark a continuation of the current trend. Regardless of the nature of the pattern, continuation reversal, the direction of the next major move, can only be determined after a valid breakout. So how would we increase our possibility of success? Well, one, we want to look at the trend. The quality of the trend, where the triangle is forming, will help you determine the quality of your trade. Because price can move this way, and it still moves upward, but that's not really an uptrend. It's kind of a mess. And that's really what the trading looks like every day. When you see a well-defined trend, higher highs and higher lows, and a triangle forms in that formation, you have a better possibility of that triangle, or a higher probability, giving you a very good high potential, high profitability trade. Whether it's an uptrend or a downtrend, the cleaner it is, and the cleaner the movements are, the more reliable it's going to be and the better trade you're going to get. Now, I would rather throw tons of trades in the trash can and never make them, and wait for me to get the few high probability trades. Me, if I do 5 to 7 trades a week, that's a lot. And I spend all day looking at charts. But that's me. Okay, as I mentioned, we always want to look at volume. We will see volume diminishing before the breakout. And that's what we call the quiet before the storm. And then we should see that storm breakout when we get a confirmed breakout, and we should see volume increasing. So the future direction of a breakout can only be determined after the break has occurred. Sounds obvious enough, doesn't it? But attempting to guess the direction of the breakout can be dangerous. Even though a continuation pattern is supposed to break in the direction of the long-term trend, this is not always the case. A break should be on the closing basis of it to be considered valid. Some traders apply a price break or time filter. The breakout should occur with an expansion in volume. Now, keep in mind that a lot of times you get a breakout, but price will return into that apex. So you have to be careful. You want to make sure you set your stop loss at the right place, because it can go back in just like you saw on my live chart and then move right back out and move. You have to have confidence in what you make. Remember, and your price target has to be set based on the width of the base of the triangle, and then adjusted if there is a major resistance or support level in the way. So in sum, triangle patterns are easy to spot and provide good risk-reward opportunities. Traders can quickly know that a big move may be near, as well as the profit objectives and the amount to be put at risk. Now that you have the knowledge of the three powerful price patterns, you are steps closer to becoming a more confident trader. So thank you very much for joining us today. I'm sorry about, I still haven't figured out what the time scenario is, because it was put on my calendar and I was here to set up the class, but we got through it. And again, thank you very much for waiting for us, and we'll talk to you again real soon. Bye now.